The April real estate numbers are in, and boy, is it a bit of a mixed bag. Many people think that, hey, the spring has sprung, the spring market is here. Is this a rebound or is it not? One thing for sure is that the sales numbers are up pretty much across the board, which is definitely a good thing. But that comes with a bit of a, like I said, a bit of a mixed bag. It doesn't necessarily mean that the market is in full recovery. What we did also see is that inventory is up substantially still over year, and have certain segments like the condo market is still very, very soft, as well as a lot of sellers still overpricing their properties in hopes of getting everything they can out of it, and buyers just aren't really reacting to that just yet. So one of the things I always like to do when I get into these videos, and certainly my blog and my updates, is to really give some context ahead of time. It's all fine and well to talk about the real estate numbers and what they are, but without context as to why they're certain trends are happening, etc. It's basically just blank numbers. So I think one of the very first things we always kind of talk about is the job numbers, the health of the economy, the confidence in the market. And so I'd like to kind of get a little bit deeper than just the headlines and try to, peel back the onion a little bit, so to speak. So March numbers came in for employment, and it showed that Canada gained 14,000 jobs in March, which was pretty good. The April numbers will come out at the end of this week here, so this video is coming just a little bit ahead of time. But as far as March goes, we like to kind of go back a little bit and peel back the onion again, right? And so as far as the 14,000 jobs created, we want to see, well, where do those jobs, where were they created? Where was their job losses, et cetera? Were they full-time? Were they part-time? One thing's for sure is that on average, we pretty much lost about 1,000 full-time jobs in March, despite the 14,000 jobs growth. As far as Ontario goes, Ontario was pretty flat for the most part, and a lot of those jobs really came from Manitoba, Saskatchewan, and to maybe a slightly lesser degree, but still punching above their weight class, Nova Scotia. So everywhere else lost jobs, including BC, which lost 19,000 jobs. So on average, when we look at the Canadian job labor market, seeing 14,000 jobs created. We want to see that those are good full-time jobs, and certainly as far as the Halton real estate market, what do those jobs mean for you and I, right? Are we getting the jobs? Are our neighbors getting the jobs? People around us that are going to be buying and selling houses and push and reflect into the real estate market, or are those jobs on the other side of the country, which is, for the most part, the case these days. Now, overall, the unemployment rate stayed pretty much the same at 6.7% across Canada, where here in Ontario, still elevated here at the 7.6% mark. So we're a little bit higher than hopefully we should be, especially given the fact that Ontario has the largest labor market across the country. So as we talk about the employment numbers, let's move on to wages. One of the things that came out recently was that the headline number for wage growth was 4.7%, which sounds pretty good, especially if inflation is going to be down around that kind of mid 2% mark. It means that we're ahead of inflation. But when you kind of strip back again, when it's adjusted wage growth, it's actually down at the 3.6% mark. Still ahead of inflation, but maybe not keeping up with with groceries, et cetera, which I think is up in the mid 4%. So just last week, the Bank of Canada decided to hold rates, not increase them, not lower them, for the fourth time in a row. So the Bank of Canada held rates at 2.25% again. And the Bank of Canada is forecasting about a 1.2 GDP growth for 2026. So not exactly that booming economy that we're probably hoping for, or maybe would be a little bit nicer at this point anyways. That would imply that potentially we would have some room for lowering interest rates. But of course, the flip side of the coin is the fear of kind of persistent inflation. Of course, we have the war in the Middle East, which is at this time, certainly pushing oil prices up. And contrary to previous decades where the oil and gas industry in Canada and natural resources, et cetera, was a lot stronger, we don't have the benefit of having the strength of the Canadian dollar to kind of counteract some of that global inflation that we're seeing right now. What that means for you and I is that in Canada we do import a lot of things, right? Certainly, food is definitely one, given that only half of our season can be really considered growing season. So when we're importing with a weaker Canadian dollar, it just means that everything's going to cost you and I more because our dollar doesn't go as far. So that is certainly leading to some of the inflation that we're seeing right now, is just basically the weakness of the Canadian dollar. And of course, now that oil is going kind of through the roof, so to speak, of course, oil is used for transportation and growing, et cetera. So that will trickle through the economy as well, and certainly down through inflation. This obviously means that the Bank of Canada doesn't have the confidence to be able to lower interest rates, which might add some more demand to an already inflated prices. Okay, so what does that mean for you and I? Why am I talking about oil prices and the global economy, et cetera, when we're talking about real estate? Well, at the end of the day, it turns all the way full circle back to if somebody doesn't have the confidence and or the cash flow or the budget to be able to purchase something, maybe even to get into a starter house, which might trickle up the chain, so to speak, where somebody buys a condo, allows that condo to buy a townhouse. That townhouse owner now can buy a semi or a small detached. That small detached can then move up, etc. If you don't have that confidence and that ability to make that purchase, then everybody downstream is affected as well. So let's get into the real estate data just right now. In Halton Region, we saw sales across the region go up about 6% year over year. In April, we had 692 sales across the board in all kind of subcategories. We also had about 1,900 new listings hit the market. And so new listings were actually down 10% year over year, which is certainly a good thing. We don't necessarily want those new listings to be, constantly accumulating, et cetera. But average sale price was pretty much flat across the board, up just a modest 1% year over year. The interesting thing, though, is that the median price, which is kind of just more of the chunk in the middle of what's actually selling, was at $1,040,000, which was down 2% year over year. So while the average is up, the median is down, suggesting that more of the higher end homes are selling. Maybe people getting into farms, or maybe the big Oakville properties and Burlington properties along the lakeshore and the lakefront. The sales to new listing ratio actually increased from 31% last month to 36% this month, which is definitely a good sign going in the right direction. We basically say that anything under 40% is considered a buyer's market. I apologize. So we are still in that buyer's market territory as far as Halton Region goes as a whole. But coming out of kind of that deep buyer's market and maybe inching towards that balanced market, on the way there anyways. Now, if we zoom into Burlington specifically, 256 sales last month, with 552 new listings hitting the market. The average price edged up as well, but the most important thing for Burlington was that it was the outlier. It was the one leading the charge as far as Halton Region goes, with a sales to new listing ratio of 46%. Again, anything below 40 we consider to be a seller's market. Between 40 and 60% is considered a balanced market. So definitely out of the seller's market. I apologize, definitely out of the buyer's market territory and into that balanced market territory, with months of inventory being around 3%. So much more competitive market in Burlington than the other cities around, the other towns and cities around Halton Region. Now, Halton Hills is always a tricky one because it is kind of such a small market that just a few sales can really impact kind of averages and trends, et cetera. But as far as April goes, 48 sales with 165 new listings hitting the market. Now, the sales to new listing ratio coming in at 29%, probably the lowest one in a little while. But again, month to month, it changes a lot. So next month, we might very well just see that turnaround completely. But certainly one to check on maybe on a more quarterly basis than maybe a month to month basis, given that it is such a small market. Now, Milton was an interesting one this month for sure because we had a big surge in the number of sales, which was good. So this is the one where we really say like, hey, spring has sprung, so to speak, where we had 141 sales compared to 87 in March, which March was probably the worst March in 10 years, if I remember correctly. So March was pretty bad. So, almost anything could be better than that. But we had, an increase of about 20 sales even from last year. So April 2025 was 121 sales to 141 sales this year. So definitely improvement on multiple stats. But the flip side of the coin here is that there was 421 new listings that hit the market in comparison to the 141 sales. So, sales to new listing ratio still down at that 33%. Now, again, last month it was down in the in the 20s. I think it was at 29% or 28% last month. So again, we're trending in the right direction. The average sale price came up a little bit, which was good as well, but terminations was certainly one that we would keep an eye on as well. So what that means is that there was 151 houses that came off the market because they didn't sell, where there was only 141 actually selling. So when you have almost a one-to-one, sales to termination, that's something to consider as well. Oakville is always a fun one to watch, given that you have such, high-end houses along the lakefront sometimes, and and the average sale price can kind of like jump around depending on how many of those sell each month. For Oakville, we had 241 sales last month, with 768 new listings. So a 32% sales to new listing ratio. Again, still in that technical buyer's market, and not necessarily close enough to the 40%, which would give us kind of a bit of a balanced market like we're seeing in Burlington. The average price in Oakville ended up being a little over 1.6 million, 1.628. With the average detached sale. So if we're just taking the average of everything, it was 1.6. We're just detached. If we're honing in just on the detached, we're over the $2 million mark on average. So I always like to wrap these up a little bit with just with interest rates, what's happening with the interest rates. So again, the Bank of Canada decided to hold last month or last week, really, at the end of April, at 2.25%. Variable rates are, probably a little bit more attractive right now. If you haven't noticed, the fixed rate mortgages, the 5-year has been inching up as inflation maybe becomes a little bit more sticky with the oil shock. There's more. The market is pricing in that inflation will be around for longer, which means that bond buyers and holders are demanding a higher return to counteract the effects of inflation. So the bond yields are starting to inch up a little bit more. So whereas last month or a month before, we might have seen 5-year fixed around, maybe on the very low side in the kind of like the mid 3% mark, mid to high 3% mark. Now we're probably going to be in that like above 4% to 4.5%, depending on your lender and and everything else that goes with it. Of course, this isn't mortgage advice per se, but just to kind of give you an indication as kind of where the fixed rate mortgages are going. But with the Bank of Canada not touching the overnight lending rate at 2.25%, that means that the variable rates are steady, and we're starting to see count off of prime, which I think if I remember correctly, I should have looked it up before I shot this video. I think that variable rates are in that low 3%, 3.3 or something like that. So you have a pretty good gap between variable rates where they are right now, call it 3.3%, to say call it 4.3%, right? So a 1% buffer between the two, with probably arguably less of a chance of an increase. And if they do increase, they're probably not going to increase it a ton, maybe 0.25%. You're still well ahead. Again, not mortgage advice, certainly something that you want to consider and think about, but after talking to a mortgage expert on the topic as well. So final takeaways for this video here and the April update. Activity is up. Buyers are certainly out there, and I'm seeing it. I'm seeing it at my open houses. I'm seeing offers that come in, but they have a lot of choice, and they're not afraid to try to get a good deal and see who's motivated. If you're a seller, you're going to want to price your home appropriately. The ones that are listing properly will be scooped up by buyers, and when they see a home that is priced well, they won't want to lose it. If it shows well, if it's priced well, they're not going to want to lose it, and they will give you fair market value for it. But you will notice that I already talked about this, the number of terminations. Those terminations aren't because aren't 100% because there's not enough buyers out, which is certainly a factor, but it's because sellers are expecting too much for the house for what buyers are willing to pay, right? So buyers listening, you have choices. We see that in the data. Sellers listening, you need to price your property at an appropriate price point so that buyers see the value. Anyways, long-winded, probably as always, but sometimes more is more, right? So anyways, I hope you found this useful. Reach out if you ever have any questions, and have yourself a wonderful rest of the month.